Hey guys, welcome back. In this video, we are talking about the AMC good news, breaking records, how shorts need money, and many more in this video. First, we're taking a look at this. Should be a wave of good AMC news from here on. Let them send the stock price lower. It will only make us richer buying more before the stock reverses to the moon. Q4 hit movies, surging revenues, record attendance, concessions, and merchandise sales, share approval, which brings MOAS. So let's talk about this. Firstly, we understand that currently we are going to be looking at a very good projection for Q4. We have so many movies coming, and at a time like this where we've seen how AMC has already had record attendance, they've improved their infrastructure, you know that they will benefit from this. When you take a look at what Adam Aaron has said, you can even see him being extremely excited. Wow, 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 wow. Wicked for Good has a 97% from Rotten Tomatoes audience. This is going to be a global phenomenon. Grab your seat before they get very scarce. And so what we are looking at, like I said, firstly, multiple movies that are coming out. Wicked for Good is one of them. And these movies are going to do extremely well. If you take a look at past data, last year at this time, domestic US box office numbers for November were almost the same. Then, Wicked movie took November to end with 900 mil. This time, we have Wicked for Good and Zootopia 2. It will definitely cross 1 billion and may end up the best November ever. So what we have already seen is how AMC is already able to make record EBITDA. Now we're going to be looking at box office to be making record months as well. And in times like this, like we've said, with how efficient AMC has made their structure, made their business, if we are able to see November cross 1 billion, if we are able to see more and more movies coming out, which increases the box office, you can understand how well AMC is going to do. And so going back to what we've said, it's very obvious we are going to be seeing good AMC news coming out. And just like we've said, with all of the things we've seen in the past, you're going to see how well AMC is going to do. And then you can see here, and this is how we really understand why shorts are worried, why we know that the box office is going to do well, why we know the industry is going to grow. Daily reminder that gauge the industry, not this fake price on AMC. And so this is very simple. Firstly, if you take a look at the companies within this industry, Cinemark and IMAX, you can see that they are already benefiting from this. And just like we've shown, we're very likely to be looking at record box office. We're looking at good movies to be released, so it's no surprise that these movie stocks are doing well. Now, when you take a look at AMC, you see that it's red, and some of you, and this is a very, very low percentage, 99% of you will know that this is because of the suppression, because of the manipulation. Maybe that 0.1% may think, well, if AMC is red, despite the fact we're seeing record box office, it must mean that they are doing bad. Well, that is not the case, and we've already known that. This is just an example of showing a institutional owned stock such as Cinemark versus a retail owned stock as AMC. Bear in mind that the movie industry is going to do extremely well. This isn't just me saying it, but this is us actually seeing data that obviously shows this. And when you take a look at some of the comparisons we've already made in the past, you have to understand AMC is already having more revenue than Cinemark. It comes to a point where AMC just has to improve their business structure even more, and that's when you will see the profit rolling in. But aside from that, it's about how AMC is able to captivate more. And so if we are going to be seeing the box office increase in their number, you can understand how big and how well AMC is going to grow. And another reason to showcase why we're not seeing AMC growing, despite the fact the rest of these competitors are, is because of this. AMC with a 4-cent move all day. And what the reason for that is because we're taking a look at mass dark pool, 80% of exchange used. So if you want to understand and see why AMC isn't moving whilst its competitors are when you're faced with good news, is because they're hiding the sell volume and the buy volume. Now, what I mean by the sell volume is referring to what Genius Group has told about recently. So in the past, we've always talked about this. When you take a look in the off exchange, you'll see that a large number of these orders are buy orders. And so we know that these buy orders are not affecting AMC. But something that I didn't really mention, but is mentioned by Genius Group within the lawsuit, is how not only is the dark pool used to hide the buy orders, so to take away any bullish volume, but it's also used to hide the short orders. So they make and they stack up a lot of short orders within the dark pool. So so it doesn't show, and then in one day they release it all to then actually have an effect on the market. This is mentioned by Genius Group in terms of what institutions use. And so when you take a look at dark pool like this, you understand what's going on. And so sometimes when we see that the off exchange is 60% as opposed to 80%, now despite the fact 60% is still above industry high, it may be the case that they were offloading these short sells to make it hit the market, to look like everyone is selling AMC, to make the price go down. And so the focus on this, the emphasis on this, is just once again, the big reason for why we're not seeing the price go up despite our competitors is because of the increased use of dark pool. Another example is taking a look at GME. So don't let them gaslight you. GME is not a piece of crap retailer. GameStop Corp could see its most profitable year in the history of the company. Now, there's already been so many cases. We already know at this point, AMC and GME is no longer a meme stock because of everything that they have done in the past. If people believe that AMC is a meme stock, if people believe that GME is a meme stock, then these two companies would have been bankrupt a few years ago. They wouldn't be on the market. No one would be talking about them. But the very fact that AMC, if we take a look at it from different perspectives, AMC has increased their fundamentals, increased their business structures, made investments that have paid them very nicely. These are all cases of showing a healthy and operating company. And the big thing about this is that AMC is not stopping where they're at right now, but actually making improvements as they grow. And so this is something that everyone has to take into note. Another example is obviously GME. We talked about this. There's a big difference between AMC and GME. AMC has shown great improvements in their business structure, whereas GME is obviously still at the beginner stages. However, they have billions of dollars of cash on hand that are able to make great investments, that are able to be invested into the infrastructure if needed. And so both companies are doing very well. And this is the quarter we're going to be looking at how GameStop could also show that, along with AMC as well. Q4 is definitely very, very exciting as we're looking at AMC and GME to be releasing good numbers. Now, on the other hand, what we are looking at for the banks, for the short sellers, is a complete different situation. AMC, despite the fact that they are being suppressed by these institutions, they are still growing. They're taking what they can from the market and using it well. What we talked about yesterday was how the use of the Fed's reverse repo falls below 1 billion for the first time since 2021. Now, this is very significant because the reverse repo was at 2.55 trillion. And yesterday it went below $1 billion. And that just showcases the illiquidity problem within the market. Now, today, if we're looking at reverse repo, we're seeing that back above 1 billion at 1.129. Now, this isn't something that is obviously worrying. This isn't something that is going to then say, okay, the short sellers are back. Like we've said, it's very likely, it's very common to be seeing the reverse repo go back up, up and down, to bounce back and forth. At 1.12 billion, it is not a worry. If anything, it just showcases the illiquidity problem within this market even more. Because there is so much more than just seeing this 1.1 billion. If you take a look at this, we're seeing it here. Dealers rebuff NY Fed as it urges use of facility to ease strain. And so this is what we've seen with how institutions are practically begging for help. They're begging for ways that will ease the strains within the market without having a massive effect. So essentially what they're trying to say is that they want the Fed to help them in a way it doesn't look like they are weak. They are in fact weak. They are in fact in need of money because of the overexposed position. However, they want the Fed to help them in a way where it doesn't show that. And so this is what they're hiding. And just like we've said, the very fact we're looking at a 1.1 billion reverse repo as we see it increase from the 900 million isn't the case that suddenly there's a massive surge of liquidity within the market. Suddenly these shorts are able to, get out of these positions, able to get help, but rather exactly solidifies what we have been talking about, the exact problems we've been talking about, and understand that these short sellers are, of course, struggling. Another case of this is like this. One of the things we talked about on this channel that we've been paying close attention to, we've mentioned in the past before, is the commercial real estate. We've known that commercial real estate could be something that triggers a massive crash, a massive sale, but more because the collateral value that it has. Now, recently, we're seeing commercial real estate brokerages files for bankruptcy. So we're already seeing how this is deteriorating within the industry, because if the commercial real estate was in a good position, we won't be seeing these brokerages filing for bankruptcy. But it's the very fact that we are, that's the reason why we've known that there's something going on within this industry. And the reason why we've said we're paying close attention to this is because of the collateral value. You can even see here, 97 million loan default. The private equity managers of the industry SLC office building, an incomplete 1,000 stall parking garage in a granary district, have defaulted on a 97.3 million loan. And so this is just small examples of what's going on. You have to understand that this is obviously going to be stacking up. I'm not saying that this is the same as the 08 crisis, but what we're looking at is that if there are already fails of loans within these markets, and we're going to be seeing it growing bigger, pairing up with the reverse repo like we've talked about, you understand where it's going on. And if you look at on the other side, all right, folks, no intervention from Bank of Japan again today, confirming that they are now stuck. The equilibrium right now is so fragile that any move in the direction can risk breaking things somewhere else in the financial system. And so not only is the US having problems, we've also talked about Japan. And this is what we're looking at with the Bank of Japan right now. And remember, the yen carry trade is something that we've talked about. And the yen carry trade isn't something that just has an effect on Japan, but actually globally as well. So don't think that this is something that's only going to affect Japan or only going to affect Asia. This is something that will affect globally. And firms that are also based in the US will also get affected by this. What you have to realize, Citadel, a short seller for AMC, as many of you are aware, has massive exposure to this. And we've talked about how the yen carry trade can easily put Citadel in an extremely bad position. And so this is why we've said that everything that's happening right now are all showing how these short sellers are going to be in a very bad position. They're not going to have a good time. But like we've said, on the other hand, we're looking at how the box office is going to be having record months. So you can see the difference between the two. Now, more on this is the Genius Group situation. Now, don't think we have forgot about this, because this is very important. And recently, as we see that Genius Group is having this lawsuit that is fighting back against these short sellers, you can see how the margin requirements are now 363%. So from here, you can already see the volatility that there is in Genius Group. You can realize that why these firms are panicking, why these institutions, why these short sellers are panicking. And that's why we see an increase in the margin requirements. So it's becoming tougher and tougher for these short sellers to be holding on to these positions. Remember that this lawsuit is something that is not only beneficial for Genius Group, but like we said, if it has a positive effect, this is something that AMC can go along with it as well. And you have to realize Genius Group has 0 shares available to borrow, and the market makers must deliver all the naked shorties sold on Monday. Before the market opens tomorrow, he cannot borrow them, so he has to buy them or fail to deliver. And so this is what we talked about yesterday as well. This is a problem that pretty much sums up what's going on. Now, the reason why this is important is because who this affects. And for those of you who are aware, Genius Group targeted Virtue and Citadel. So the reason why I say this is because that means that Virtue and Citadel has a stake in naked shorting Genius Group. It means that some of the collaterals are also tied up in this. So this lawsuit is not only good for us in a way that if we're seeing how regulations is going to side with Genius Group, meaning that they could also side with AMC when we do decide to go that route, but the immediate effect of putting pressure on Citadel would also means that it puts pressure on the AMC shorts as well, because Citadel would then have to increase their margin for Genius Group, for AMC, and for GME. And like we've said, margin requirements are now 363%. So you can imagine how Citadel is forced to increase their margin. And then we're looking at the brokers as well. Once again, just showcasing how these brokers aren't here to help out the institutions, but rather to help out these brokers aren't here to help out the retail, but rather they're here to help out the institutions. And this showcases why we've said that our squeeze was stolen by the brokers. You can see second day in a row of not being able to place an order of Genius Group through the Schwab app. So now I have to call an account rep to buy. Give me a break. And so you can see how they're increasing the difficulties for people to buy. Now, the reason for this is very, very simple. It's a very simple tactic. Firstly, they know that if they were to remove the buy button, that Genius Group will have a plausible lawsuit. However, it's not only that, but it's a psychological tactic behind that. For those of you who are potentially in marketing, you will know that sometimes what people do to stop people from canceling a service is to make their cancellation extremely, extremely difficult. And so in this case, by making the purchase an extremely difficult thing to do, it deters people from buying a stock. And so that's what they're trying to do without removing the buy button. And another case of how institutions are abusing the market, you can see the Nasdaq has charged Bluefin Capital Management with failing to report data for 3.2 billion orders. The fine, 125K. And this is what we've said yesterday. These institutions have used methods that have made them hundreds, if not billions of dollars of profit. And the only time they have to get punished for it is by paying $100,000 or $1 million fine. If I were to give anyone this opportunity, if I said to you, you are able to make $300 million, but by the end of this, you have to pay me $1 million, would you take that deal? And I would say that 9 times out of 10, and I'm being extremely conservative here because I'm very positive that actually 10 out of 10, but I'll say that 9 times out of 10, people will take this deal. And this is exactly what these institutions are doing. And they're doing that by taking the liquidity away from retail. And so this is why we said that this is something that needs to be talked about, that the regulations need to obviously force more punishment. Now, the thing that we talked about, you can see, is of course the illiquidity issue. Now, one of the reasons why we talked about why there could be a massive market crash is because of this so-called AI bubble. Now, we've talked about how, of course, a lot of stocks are extremely overvalued. Now, Nvidia has their earnings today. By the time of this recording, they would have been done. They've already broken their revenue. But what we're looking at is how this is obviously showcasing that there is a massive bubble. And the reason why we say this is because the Financial Times has reported that Oracle's $300 billion OpenAI deal is already underwater. It's now worth minus $74 billion. And so this is just showing that everything we're seeing right now is extremely inflated. And like at any point, we could be seeing it all crashing down. And that will mean collaterals will disappear. That means AMC shorts will have to cover. And that's when AMC will squeeze. As always, this is Ed Financial Advisor. Do take what I say of salt. Make sure you do your own due diligence and research. And I'll catch you guys next time.